We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Mega-cap tech carried Wall Street as the Nasdaq surged over 2%, powered by Amazon, Alphabet, and Nvidia, while the rest of the market lagged behind. The Fed delivered a 25 basis point cut, but warned December's move is far from certain, keeping volatility alive. In Europe, inflation cooled toward target, giving the ECB breathing room, while the UK surprised with a housing rebound ahead of the Bank of England's key rate call. Over in Asia, Japan's Nikkei soared more than 6% on stimulus hopes as the yen hovered at intervention levels. But China's vague policy signals and weak confidence kept investors uneasy despite a temporary US-China trade truce. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Last week of October, well, it wasn't just ambivalent, was it? It felt more like a total information collision.
Definitely. You had corporate earnings basically redefining market caps, these big geopolitical moves bringing temporary calm, and then central banks showing really different philosophies.
Yeah, it was like walking a tightrope over pure momentum, honestly.
It really was a chaos of signals. So for you listening, our mission today is simple. Give you that strategic shortcut. We want to help you separate the real signal from all that deafening noise.
Okay, so the plan.
We're hitting the regional recaps, US, Europe, Asia. Then we're drilling down into what looks like an absolutely critical calendar for November 3rd to the 7th.
Right, and that week looks loaded with potential landmines, especially with the political uncertainty hanging over things.
Precisely. And then finally, we'll leave you with the crucial top 5 risks, the things that absolutely must be on your radar as we step into November.
That's the structure. And, if I had to boil down the whole week into one thought, it's that we ended October feeling weirdly powerful, but also kind of dangerously narrow.
That's the perfect way to put it. A handful of these mega-cap tech stocks just kept climbing, powering the indices.
While everything else struggled.
Exactly. The vast majority of the market just couldn't keep up. So the central question, the one we have to answer going into November, is whether this extremely narrow tech rally can possibly sustain the whole global market.
Or if it's just building up pressure for a correction.
Yeah. Is it sustainable or is it a pressure cooker? Let's unpack that.
Okay, let's start in the U.S. then, because that performance gap was, well, shocking. S&P 500 up, 0.71%? Modest. But the Nasdaq, it just surged 2.24%.
Yeah.
Why is such a massive difference?
Well, it's almost entirely down to that continued dominance of large cap tech, plus this ongoing AI optimism cycle. You saw Amazon and Alphabet both posting really strong surges after their earnings came out.
And Nvidia.
Oh yeah, Nvidia hit new record highs again this week. Its valuation is, well, comfortably in that $1 trillion plus club now. That signals some serious institutional confidence in future tech profits.
But hang on, if the rally's really just 2 or 3 massive names?
Yeah.
Is it truly AI-driven optimism? Or is it maybe more like speculative hype around a couple of fantastic Q3 earnings beats?
That is exactly the right critical question you should be asking. And the data, it does suggest caution.
How so?
We're seeing clearly broken market breadth. Even giants with strong fundamentals, think Microsoft, Apple, Meta, they actually finished the week lower.
Despite good earnings for some of them.
Right. And smaller caps lagged way behind. So you're right to question it. This rally is being powered by a very, very small, very concentrated engine. If just one of those big names stumbles,
The whole index could follow pretty quickly.
absolutely.
Oh, so narrow performance. And then the Fed definitely added some complexity. They cut rates, 25 basis points, taking the target range down to 3.75% to 4.00%. That part was expected.
It was. But then Chair Powell spent pretty much the rest of his press conference pushing back hard against the idea that another cut in December is, a sure thing.
So more ambiguity.
Exactly. And that ambiguity is what drives volatility here. He explicitly said a December cut is not a foregone conclusion. And what's fascinating is you can see the division among Fed officials themselves.
So split, huh?
Clearly. They're caught between, on one hand, this threat of sticky high inflation, and on the other, incoming data suggesting the labor market might be weakening.
So that internal tension means every single piece of data gets magnified from here on out.
It really does, because no decision seems unanimous right now.
Geopolitically, though, we did get a bit of a temporary tailwind, didn't we? The U.S.-China trade ceasefire.
Yes, that definitely provided some necessary temporary relief. We're talking a one-year truce, reduces some tariffs, and crucially, it resumes trade in agriculture and rare earths.
Take some immediate risk off the table for investors.
For now, yes. But interestingly, it didn't stop the bond market from selling off after the Fed's comments, which tells you where the real underlying concern lies.
Treasuries sold off.
Yep. Pushed the benchmark 10-year yield back up to 4.09% by Friday. That reflects that persistent inflation anxiety.
Okay, so the U.S. powered by a few stocks, held back by a cautious, divided Fed. Does the picture look any, well, cleaner across the Atlantic? London, Frankfurt.
Marginally clearer, maybe, but still pretty mixed. The broad STOXX 600 index was down about 0.67%, but the UK's FTSE 100 actually managed a gain of 0.74%.
What drove that?
The key driver seems to be the improving inflation picture over there.
And how did the ECB, the European Central Bank, react to that better data?
They held steady, kept rates unchanged for the third meeting in a row. President Lagarde is trying to thread a very fine needle.
How so?
Well, she acknowledged the subdued inflation headline CPI dropped to 2.1%, which is nearly their target, and core held at 2.4%.
It's pretty good.
It is. But she immediately followed up with caution, warning specifically about these persistent external risks, global conflict, energy prices. It suggests they're extremely sensitive to any potential shock that could knock them off course.
That 2.1% CPI is really close to target, though. Suggests maybe they're near success if the economy holds up.
It suggests they have some breathing room, definitely. And Q3 eurozone GDP was slightly better than feared, came in at 0.2%. France and Spain led the way.
Not exactly roaring growth.
No, but it's avoiding stagnation, which frankly is a win in this kind of environment. And the UK actually provided a genuine bright spot that surprised quite a few analysts.
Oh, what was that?
The housing market. Nationwide house prices rose for a second month, and mortgage approvals hit a 9-month high. That suggests some resilience in consumer confidence, even with high rates. Usually, that sector is the first to buckle.
Okay, now, Asia. This is where it gets really interesting, right? Two massive economies, Japan and China, seem to be heading in completely opposite directions. Huge structural imbalance there. Japan's Nikkei 225 absolutely surged up a massive 6.31%. What on earth fueled that?
Japan is riding this wave of extreme hope for fresh stimulus, especially targeted stimulus for their strong auto and manufacturing sectors.
And the Bank of Japan played a role.
Absolutely. The BOJ contributed to the optimism by sounding, well, less hawkish than expected. Governor Ueda kept rates on hold, yes, but he focused heavily on future wage negotiations and sort of downplayed the immediate inflation benchmarks.
Signaling policy patience.
Exactly. And for equities, that kind of patience is basically rocket fuel right now.
But that strong performance comes with a pretty serious ticking policy time bomb, doesn't it? The weak yen.
Oh, absolutely. The yen is trading right around 154 to the dollar. That level is highly sensitive.
And triggers warnings.
Immediately. Verbal warnings came straight from Japan's finance ministry. That introduces this constant, acute risk of direct currency intervention. Traders in Tokyo are essentially playing chicken with the Ministry of Finance right now.
Waiting to see when they step in.
Precisely. Waiting to see exactly when they'll act to support the yen. That threat is a huge variable for the global currency market.
Meanwhile, over in China, a policy disappointment that seemed to completely overshadow any positive vibes from the U.S. trade truce.
That's right. While the trade deal offered a temporary lift, markets were really unimpressed by the policy signals from that key strategic meeting, the fourth plenum.
What was the issue?
The plan talked a lot about boosting consumption, which is structurally needed, no doubt, but it was just seen as entirely too vague. It lacked specific, immediate fiscal or regulatory measures needed to actually drive near-term growth.
And that vagueness hits right at the core structural problem holding China back, doesn't it? That consumption gap.
It really does. Chinese household consumption is still only around 40% of GDP.
Which is way below the global average.
Drastically lower. So until policy signals get concrete enough to actually encourage people to save less and spend more, substantially more, then this policy inertia and weak household demand will keep dampening market confidence. Doesn't matter how good the trade optics look short term.
The structural reform story just seems stalled.
Pretty much, yeah.
Okay, let's shift focus then. The week ahead. November 3rd through the 7th. Normally, we'd have a clear path of major U.S. data releases lined up. But there's a huge constraint now. The ongoing government shutdown threat.
That shutdown is just a massive self-inflicted wound for market clarity. If it persists, we could see critical U.S. data releases delayed, maybe postponed entirely.
And these are releases the Fed relies on.
Absolutely. We're talking about the ISM Manufacturing and Services Indices, your measures of business confidence and activity, JOLTS's job openings measuring labor demand, the ADP employment report, and, critically, Friday's non-farm payrolls.
Okay, if that number, the payroll number, usually the single most anticipated data point each month, if that gets delayed, what does that practically mean for markets day to day?
It means the Fed is basically operating in the dark, which leads to maximum guesswork, maximum volatility. If we don't have the data, you can't accurately price in the Fed's next move.
Policy paralysis.
Exactly, which investors absolutely despise.
All right, so beyond the potential U.S. data crunch, what are the key global highlights we need to track next week?
Well, the biggest global event is definitely Thursday's Bank of England interest rate decision. Given those mixed signals we talked about, lower inflation but surprising housing strength, their forward guidance will be absolutely key.
What else?
From China, we get Monday's Caixin Manufacturing PMI. That's a crucial health check on their factory sector. And then Friday's trade balance figures from China, too. Plus, Germany's trade balance numbers also land on Friday.
So even if U.S. data goes dark, expect global volatility anyway.
Oh, definitely.
Okay, now we get to the need-to-know list. The 5 variables that could genuinely disrupt this already pretty volatile momentum and inject major shock waves into November. Let's spend some time on the top 5 risks to watch.
Right. This list is really about connecting those triggers we've been discussing to the potential market outcomes. What could actually happen?
Risk number 1, then. U.S. jobs data disruption. We just covered the delay threat. If non-farm payrolls don't get released on Friday, what's the single most damaging consequence for risk assets, for stocks?
The most damaging consequence is simply the collapse of forward visibility. If the jobs data is delayed and you combine that with potentially delayed ISM and JOLTS reports, the whole policy picture just vanishes. Meaning the bulls can't argue the economy is strong, the bears can't argue the Fed has to be hawkish, volatility spikes because investors are effectively flying blind. They'll likely assume the worst. We really need that non-farm payrolls number released on Friday to prevent a full-blown policy clarity crisis.
Okay. Risk number 2, Fed policy ambiguity. Powell pushed back hard on December cuts. But, if I'm an investor, I might think, is he just bluffing? Trying to keep his options open?
He's absolutely not bluffing. He's reflecting that very real internal division we talked about. The risk here is a sudden, sharp repricing of rate expectations.
How might that happen?
Let's say the small amount of data that does manage to get released, maybe next month's CPI, comes in surprisingly hot. Or perhaps the upcoming Fed minutes reveal the hawks are gaining more ground internally than we thought.
Then the market pivots hard.
Instantly. Pivots to assuming no more cuts this year. That would likely lead to a sharp sell-off in bond markets and put serious pressure back on equities. So keep a very close eye on any Powell speeches and definitely those Fed minutes.
Got it. Number 3. China's fragile confidence. That policy vacuum from the 4th plenum feels very real. What does the market need to see to avoid a deeper slide in China-related assets? And what's the critical trigger to watch next week?
The market needs specifics on stimulus, not just vague promises. As for triggers, the critical ones next week are Monday's Caixin PMI and Friday's trade balance.
Why the Cates PMI specifically?
If that Caixin PMI misses expectations, it basically signals that manufacturing activity, the factory floor of the world, is slowing faster than people thought. And because China is so central to global supply chains, a weak reading there amplifies pessimism everywhere about global trade volumes, about corporate profits. It's not just an Asia story.
Okay. Number 4, and maybe the hardest to predict, geopolitical surprise risk.
Yeah, this risk remains acutely high. We got that temporary relief from the U.S.-China truce, okay, but that's a short-term bandage. Middle East tensions are still simmering, which brings risks around oil prices and general political instability.
And the market feels complacent.
Surprisingly so lately. The danger is that any renewed hostilities or maybe a significant setback in the U.S.-China relationship, like a new tech export ban or something, could deliver an immediate sharp jolt across global markets. The risk premium being priced in right now just feels too low for the actual geopolitical landscape out there.
And finally, number 5, BOE decision uncertainty. Why is the Bank of England's decision next Thursday uniquely tricky right now?
Because they're juggling genuinely contradictory data points. You've got easing inflation, which argues for holding off, maybe even cutting soon. But then you have that surprising strength in the housing market alongside pretty patchy overall growth.
So the risk is they lean hawkish.
The risk is they deliver a surprise hold when some expect a cut, or maybe just sound surprisingly hawkish in their statement. They might fear inflation could just reignite if they relax too soon.
And that would impact UK assets.
Immediately. It would pressure UK equities and likely cause a sharp strengthening of the pound. Their job is managing market expectations around that very delicate balance. Thursday's rate decision is absolutely key for setting the tone for UK assets for the rest of this year.
So wrapping this all up, what does it mean for you, the listener, trying to navigate this environment? It really feels like the market's focus is squarely back on macro data, assuming, of course, the political system actually allows that data to be released.
It absolutely has shifted back to data dependency. We're heading into November with this really profound dual theme. On one hand, you have this persistent, strong, headline-grabbing performance from that tiny handful of mega-cap tech names.
But that's balanced against
Dangerously narrow market breadth overall, and the unavoidable fact that geopolitical and policy uncertainty is significantly elevated across the globe. The Fed is clearly in wait-and-see mode now, and that just creates a fundamentally choppier, less directional environment for investors.
Yeah, it's the cost of living with all this policy uncertainty. We did get that temporary relief from the U.S.-China trade truce, which, was a welcome sign for corporations' global supply chains.
It's definitely necessary relief, yes. But it prompts, I think, a really critical question for you to mull over as we head into this potentially volatile month. How much is the market truly pricing in for the long-term structural cost of geopolitical decoupling?
You mean the shift away from pure efficiency?
Exactly. The fundamental shift away from just-in-time efficiency towards national security, towards reshoring. How much is the market weighing that long-term cost against the very short-term benefit of just resuming, say, agricultural trade with China?
Yeah.
That long-term cost, that's the shadow hanging over global growth prospects, and it's the critical structural factor that you as an investor really need to anticipate going forward.
A perfect thought to leave you with. Anticipate that shadow. Stay informed, everyone. Stay ready for what could be a choppy November, and we'll be right back here next week to dissect all the market action.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.